Hey guys, Jay here. This is smarthelping.com. We've got another financial model here for you. This time we're in the hospitality slash real estate space. Um, what I'm going to do is try to explain at a high level what the model can do, and then we'll go into each tab. But the idea is you're doing a business that has events like weddings, corporate events, and such. So it can be seasonal. It's kind of like you're renting out. Well, there's a bunch of different income streams and direct costs. I also allowed for the option of acquiring, purchasing, or building a new site that you're going to use to rent out, and all the different debt logic for that. There's also a lot of different waterfalls for 4 different joint venture options. Also, just if you're not doing joint venture and you're just doing this alone with your own equity, that's completely fine as well. Um, but high level, the global control is going to have a lot of primary assumptions for timing, and we'll get into it more as we go. You've got your venue assumptions, development, catering, helper, debt schedules, OPEX, other one-time costs, your pro forma, annual pro forma, sources and uses, executive summary, visuals, and then we've got our different joint venture waterfalls here, depending on which scenario you want to use. I did 4 options. 3 of them are annual only. The first one is a option for monthly IRR hurdles. All right, so let's get back over here. And if you want to download this, the link is in the description. Uh, it'll be in multiple bundles as well, real estate industry specific. Uh, maybe hospitality bundle, obviously. We'll see though. Um, okay, so starting off with the global control tab, you can put the start month of the forecast. This actually is not really tied to much. It's just going to show you references for what the dates are of your forecast. Length of forecast, this will define the model. So you could do 120 months. Um, you could do 60 months. You can see here on the executive summary, it automatically updates depending on the amount of months. We'll put this back to 120 here. So on the left side's mostly distribution, contribution logic for different scenarios. I labeled them like 1, 2, 3, and 4. Number 1 is the monthly hurdles, and this is actually a situation where you can define on the monthly pro forma the money you're getting from investors in row 220 and the distributions in 221. Now this is a manual distribution option. There's also automatic distribution options where on the global control you could define the start month of that and then any minimum account build balance you want to keep, and then any cash above that will be distributed starting in whatever month you define here. So that's just for the option number 1, and you can see we're not distributing anything till month 60. Here we got 5 million we can clear out and still stay above 3, so we could distribute that. And then as we go forward here, we have it's seasonal, so you can see the higher cash flow months, and we'll get into how to define seasonality assumptions in a bit, but those are the higher months. And it goes to the end, and at the end you clear out, you've got the exit value, and the capital balance is also distributed at the end. So that drives the IR hurdle waterfall, the contributions and distributions inputs, which will go to the monthly IRR tab, and you can see that is happening here. And if you go down, you can see the summary of the investors and sponsors cash flows there. This is one where you want to keep the operating account balance above 0. So based on the cash flows of the project, you can define how much money you're going to need to raise and then how much you have available to distribute over time, and this capital count should stay above 0. A lot of times what I'll do is just if you change the assumptions, you'll have to change this, and that's the main point I want to get to right now is the investor contribution amount will need to change. It's not automatic. It's a hard-coded number here. So if you change the assumptions, like, for example, maybe you raise 70% or borrow 70%. Now your minimum required is only 5.6 million. You had 6.3 here, so you could change. You could either just copy, paste values only here to solve for the exact amount. Now the asset management fee is also going on. So as you change that, this can change. You could just raise maybe a little buffer. So maybe I'll put 6 million if the minimum is 5.6. But the point is you got to change that number if you change your assumptions. Let me undo that. Wait, what was it at? 70. Put it back to 60, I believe. Yep. Okay. And then that goes for numbers 3 and 4 as well. On here, the IRR2 and preferred return, you're going to manually define the investments and distributions. And then you've got a capital account here on both of these where it shows how much cash you have available based on the operational cash flow and then what you've put in versus taken out. Preferred return, same deal. Okay, so yeah, it's just important to know those change. If you change assumptions, you got to go in and change those because that will affect all these IRR figures here. Now you don't have to do them all. You might only use one. The only one that's automatic is number 2. That's just I've got all the logic automated for this. It shows the minimum cash required up front and then available distributions after. And it's got an algorithm here to work with the series of cash flows so it does the right amounts and doesn't double count or undercount anything. So this will update as the assumptions update. So that's one where, and it's annual only. That's one where you don't need to change anything, just the investor contribution rate and distribution rate here. Those percentages apply and all this auto updates as everything changes. But number 1, 3, and 4 are more manual. Okay, so that's that part. Let's get into, so I want to skip over the debt at first and start with the venue assumptions. So this is your operations. You could define the start month that you open for business. You've got 3 types of bookings: weddings, corporate events, and private parties, or you could change the names of these and they will update throughout the model. And here we're defining the annual expected events of each type. And then based on that annual amount, we're doing the percentages that those total events happen within each month of the year to account for seasonality. So it might be even, might be more in the summer months, winter months, depending on what you're doing. But just remember, even if your start month is 7 here, you want to put your expected annual volume because you don't want to put less here and then say you have even a less of a percentage, say in these months. Let's say if we're not starting until month 7, okay, then month 6, 5, and 6 you usually have 20%. Well, we're technically not counting. We're not counting those. So this 25 should be the amount for the full year, so you're getting the proper amounts here. Like, you don't want to reduce this by the amounts that are not being counted, because then you're just going to short yourself. So you want to put the expected annual volume, assuming you're open for 12 months here, but you can still adjust the start month, and it'll just start whenever. It'll just pick up whatever month that is, and that's fine. And you want to do it's important to have that offset because you're going to have construction going on, and investor money is going to be tied up, and you should be accounting for that time, however long it takes before operations start. That's important. That holding time is relevant to track. So you're able to do that with this. So you adjust the annual events per each type. So each year you do a new number. That's the annual amount. And then they all follow these schedules here for how many of those events happen in each month of the year. This is a little helper just to show you based on what you're putting in up here. Here's the first 5 years, how many events you're going to be doing per month for each type. Just so you can see, as you change these percentages, you can just go right here and see how many you actually mean to put in based on what you've input. All right, so that's the volume of events and by type and seasonality. We then have the unit economics here, and so we have revenue and direct costs. First, I tried to do these in sections as well. So number one is going to be just your regular bookings, how much people pay to reserve the place, and that's going to be different for different types of events. Also, you have an annual price change here that applies to each separately. Number two is going to be catering. So, I mean, you could include all these costs in just this booking fee and just say this will include everything, but it can be better to break it out because you're going to have direct costs related to each of these. So here we could say, okay, here's the rental fee, and then a certain percentage of those events guests are going to be using the in-house catering of the venue, and you could put that percentage here. So let's say you had 100 events, 80% would mean 80 of them, 80 of the weddings are going to use catering. You could put the average guest count because you're going to need to know that for revenues. So here you can define the price. You have three options here: a basic, a premium, and a deluxe catering package. The cost per head, and then that'll multiply by this to figure out the revenues for each of those, for each event. You also put the percentage of events that are using each type. So here we've got, the percentage that are doing catering, and then of those, the percentage that are doing basic, premium, or deluxe, and then the pricing for each of those. Then I've got a helper, the catering helper tab. This is where you can derive a price per head, or the cost per head, which is going to flow through the model. This tab is used, so put numbers in here that are relevant. Even though it says helper, this is relevant inputs that flow through to the model. And basically we're trying to get down to this number here, the weighted average cost per event for catering packages for each of the types. So for example, you would say, well, what does it cost to serve 125 people? In this case, 15,000. So that would include all of the food, potentially staff for the time being, and then we're just doing a division problem to figure out the cost per head, and then we multiply that by whatever your venue assumptions guest count is, and well, that's kind of happening because we're taking a weighted average here, but you can see the margins right here. So if this is your weighted average revenue, well, we don't care about these are the margins you're earning on each of the different catering packages, but we're taking a weighted average to get the total. So we look at all three of these, we weight it against the volume and pricing to get the correct weighted average cost per event here. In this case, for weddings, based on the amount of people doing each type and the pricing and all that, it's going to cost $25,000 on average for the company, and the revenue is $45,000 on average. So that's your spread of what you're making on everything in relation to just catering. You see catering, we haven't broken it out here. These are just total revenues of all package types, but we do break out here in direct costs what you're spending on catering, beverages, add-ons, and we'll go down here. Then you could define the average increase in catering prices and catering costs, and that applies dynamically. Number three, so some of the events you might have beverage and bar packages, so they're paying some percentage of customers will pick that, and then of those you can pick the percentage of guests that pay for beverages, and then you've got a price per head, expected gross margin earned on the beverage, and then also the cost of bartenders for each event on average. And then we did a breakdown here. You've got average beverage revenue per event, average beverage cost, and average gross profit per event for each of these types, as well as pricing increases here for beverage pricing and bartending costs. Okay, percentage of events with add-ons. So this is just some other add-on that you're offering that you can upsell. What's the average amount of that? What's the margin you're earning on it? And then here's your gross profit. And then same with, well, not same. Number 5 is going to do the percentage that use a third-party vendor. Now, third-party vendors are, for example, if you as the venue have relationship with photographers, florists, or what have you, and you get paid a small commission, maybe 15% or 10 or 20, whatever you can negotiate, in order to refer your customers that are attending these events to use your vendors, and then maybe you'll make some percentage on whatever the total average spend is on those vendors. Now note number 4 and 5 both have both pricing is going to go up based on the catering price percentage. So I use this 2% to apply to catering, as well as the pricing on add-ons and vendor spend. So those all go up each year based on this percentage. Then we also have direct costs per event. So coordinator, setup crew, cleaning, turnover, linens, whatever. For weddings, corporate events, and private parties, you can define every time you have an event, what are your total costs? And then those, I've also used the catering pricing for that to go up. Now that's obviously an expense, so it's going to use the cost here. You can see I put notes to try to explain better. But this 1.5% will define how these costs go up over time. And then as you change these assumptions, you can see over to the right how it affects total revenue, costs, gross margins, net operating income, and then you can see actually all the way down to cash flow. And then I did the project IRR and an investor and operator IRR for the first two, number 1 and 2 options for joint ventures. All equity up front versus the monthly hurdles. Let me double check that. F28. Yeah, this is the monthly hurdles, and then all equity up front's this one. $27 and $43. Oh, let me double check this. So these actually might be referencing, let me update this, investor IR hurdle. Oh, sorry. I confused myself. So this is the investor's IRR for monthly hurdles, the investor's IRR with all equity up front, and then the operator's IRR for hurdles, and the operator's IRR for equity up front. Okay, so that makes sense. So these are equity up front, 33,147, which is this, and then 33,93 would be the monthly hurdles. Minimum equity required, and then ending debt balance here. So it's nice to see how those things change as you change the assumptions. Development costs, so you could be doing a purchase with renovations, or you can, if not, you can just zero that out. And make sure if you do zero this out, you also put a no, make sure the refi is at no, or else it will refi. And so if you weren't purchasing, if you're just developing, you put all your development costs here, the percentage of those costs that are spent in each month up to 60 months, and then whatever you put here for loan to cost for new development, so 65%, that's going to flow right to your development D1 schedule for what you borrowed. You have an interest only period, and you want to make sure the interest only period is long enough to cover your maximum draw or usage of these costs here. And these should all add up to 100% for each row. Here's the check. So there's your development. And then also maybe you have some development costs that you don't want to automatically get a loan on. So you can put those in here, and these are just going to hit cash flow. There's also developer fees, which is a GP fee. You'll define that in the GP fee section here. And that's just applied to the total construction costs. So there's that. Catering helper we went through. So A1 and A2, this is your acquisition and seller financing loans. So if we were purchasing, let me just put those numbers back in there. So purchase price $5 million, some quick renovations. Here we're just assuming the total loans just happening up front based on this loan to cost, closing costs. You've got the IO period, that might or might not be relevant. If it's not, you can just put 0 here, and then you can see it's going straight into P&I. You can see the total principal and interest payments over here, and the total repayment at the end, which is on exit. Put that back to 12. Then you define, after the interest only period, you could define the amortization term of the loan interest rate here, which could be different than the IO rate, or it might be the same. And then you could choose to refi. And if you put yes here, I've put in month 36, then you're going to see a refi happening. Right here, month 37, the repayments start, but month 36 is when that cash flow will hit for the refi amount. And then automatically the acquisition loan gets repaid. The seller financing loan gets repaid, which is the seller financing assumption, I believe is, where is that? Right here. So this is also going to apply to the purchase price and be a second amortization schedule in A2. So that gets repaid, and then you refi it, and then that goes to the exit month, whatever that might be. So all dynamic, you don't got to do anything with these. Just configure it on the global control right here. Okay, so then new development is just loan to cost, closing costs, IO period, IO rate, and then at some point you'll switch to amortization. Most likely, here's the terms of that, and then you have the option to refi this as well. If I put yes here, and let's say it's in like month 48, and you can see all these numbers are changing. We'll have to go update numbers 1, 3, and 4 when we're done. The refi, in both the refis, you can define the cap rate, which is going to just apply to the trailing 12-month net operating income of the refi month number. And then you do a percentage of that is going to be borrowed, your loan to value, and then you got closing costs on that, and then the terms of that refinance loan. So here you can see my construction loan, I'm paying on interest only, and then it switches over to amortization, and then in month 30 or 48 we refi, so that gets paid off, and we have refi amortization starting, and then that closes out on the end month as well. OpEx, pretty simple. So this is like, and also this could be a situation where you're not purchasing, you're not building, you're just going to rent, you're just leasing the actual building, and you're just running the venue services, and you're leasing out the building, paying a lease. In that case, you zero all these out. Zero out the purchase price renovations, zero out the loan to cost here, zero out the development costs, and then you would just, on the OpEx tab in the G&A, just put rent and whatever you have to pay for rent, and that will lower your net operating income. And so on exit, like, that's kind of where you get the value of the building. If you're not leasing it, then your net operating income is going to be higher when you go to sell, and that cap rate is going to result in a higher value, which will reflect the building. If you lease it, that lease is going to reduce your net operating income, which then reduces the multiple you're selling at, or the cap rate's going to be, whatever the cap rate is, the value will be less based on that. So that's kind of how that works. But anyway, you can pick the start month. The lease is going to start being paid, and usually be month 1 if it's already ready. Or you might be doing some light renovations, which you can still account for here, and then put the start month of the lease, the starting amount, and then how it goes up over time. Now this OpEx, these are all based on the percentages here, and then I did a couple rows in both sections where you can just manually define whatever the annualized cost is, and keep in mind these are annualized costs here. So you put whatever you're paying on the lease per year, and that'll go as an expense. Other one-time costs, this is just going to hit in period 0. Just other setup costs, could be legal fees, what have you. So then once you've set all those things up, you've got your monthly pro forma. So we've got revenue. First we start with the event count of each type per month, and then you've got wedding revenue. So here's your rental fees, catering, beverages, add-ons, third-party vendor referral fees, and then you've got that for each of the three event types. Then you've got your expenses, direct costs for each of the three types. So wedding, here's all of those costs. Corporate events, private parties. You've got total direct costs, gross profit, gross margin. Then we have our fixed overhead items. And again, with this OPEX tab, you would also maybe put staff in here if you have other ongoing staff not directly related to each event. Insurances, maintenance for the building if you own it, and just any other fixed ongoing costs that don't really change with the level of events happening. So that's these items. Then we do have costs as a percentage of revenue. So like if you're paying a property management fee, that is a good place to put that, and that's in the OPEX section down here. So like this will just be a percentage of the total revenue. Then you've got net operating income, and then we have our other cash flow items. So here you've got things like purchase price, your renovations, then the construction costs, non-finance construction costs. Then you've got all your loan activities, which you have your acquisition and seller financing loan proceeds if you're doing those, and then the resulting debt service. You can see the interest-only periods happening here. Then we switch to perm. On the other one, it's interest-only the whole time because it's usually that's what happens with seller financing, and then they're getting paid back on the refi. Then you've got your refi loan here, so you can see cash going out to pay these loans back, then the refi value coming in based on that cap rate and LTV, and then the new debt service. You've also got closing costs on all the different loans. Then down here we've got the construction loan. So interest, you can see it's going up as you're drawing on that. And then you switch to a perm loan here, and then I think we're refinancing that one in month 48. So here's the money going out to repay that loan, and then the proceeds in here, and the closing costs, and then the new amortization. So that's all your debt. I did do a total debt service calculation here, so you can figure out your debt service coverage. In lower months, it's lower because we have some seasonality happening in this scenario. So here we're not covering the debt service. Then here, anything above 1 is you have enough net operating income to service that. Then going down, we have other closing costs, other costs at closing, which is defined on the global control right here. We have other startup costs, which is your other startup costs there. Exit proceeds, selling fees, that's going to happen at exit. And then we have GP fees, so this is if it's relevant, if you're doing a joint venture, or some kind of private equity deal, and the operator is going to collect fees, then these are where those all show up. And note, this doesn't mean you need to use all these, or if it's common to use all these. I just wanted to put enough options so that whatever fees you think you are charging as an operator, you can enter there and see what the effects are. You might have no fees. You might just do an acquisition fee. It really depends on every deal is different. So you can configure those as necessary here. You can see our numbers on numbers 3 and 4 have changed. We'll also have to update our equity profit 1 investment amount because that's going to need to be, this amount's going to need to change possibly. Well, actually, no. So the assumptions I updated only affected, looks like the exit value or the distribution. So the equity upfront is still good. It looks like we got $17 million more to distribute. So I'll show you how that works in a second. Then at the bottom of the monthly detail, like we've already discussed, here's where you can put in. So here's the cash flow of the project itself, this is the most important row of the whole model probably. This drives everything else. So this is what your actual project cash flows look like each month. You can overlay that then with investor contributions. And we already talked about the distributions, automatic distributions, operating account balance. Annual pro forma is the same exact thing, just on an annual basis. And guys, I just tell you this, it took a lot of concentration, a lot of brain power to just get everything flowing together. And I'm telling you right now, There's no AI on the planet, unless it was trained on my specific modeling frameworks, they cannot get close to spitting something like this out that's this custom. It will never, ever happen. Um, I mean, maybe in 100 years, possibly, depends, but the level of human touch that this needs to make it work and everything, all the formulas flow and it work, it just is so far from ever being automated. It's crazy. Because I tried and it did not go well. It's just it can't. The AI can't create Excel sheets just like the basic. Like I used GPT Pro 5 and it was not even slightly close. Um, anyway, I mean, it could be interesting to have if a company wanted to use all my template libraries as machine learning and somehow then build models based on that and license the IP. That would be an interesting thing for me to pursue, I think. But other than that, right now, nothing on the market is even close to spitting this out. So um, I feel pretty secure in my services at the moment. Okay, so that's the monthly and annual pro forma. Our sources and uses are pretty detailed. You can see all the sources of cash, the equity investment, which here, obviously there's 4 different investment scenarios with different joint ventures, but this is just assuming the minimum equity required. And then you've got your acquisition loan, seller financing loan, construction loan, and any net operating income that's positive that was used. So this is like if you're making a profit, but you're still using that profits to pay for different things in the initial couple of months or years, that amount dynamically comes into here. So those are all our cash sources, and then we have uses. Obviously, we're the purchase price, renovations, other costs at closing, other startup costs, closing costs on the acquisition loan, and then we've got GP fees, acquisition fee, organization setup fee, guarantor, partial uses. So these are where you might like these costs are happening over time, and you may or may not be stabilized at that point. And I've dynamically calculated the month of stabilization. So these are all the costs that happen up until that moment, which would contribute to the minimum cash required, and therefore would be counted as a partial use of funds. Now, in these cases, most of this is the total amount of that cost, but sometimes it might not be, depending on um, when you're hitting that minimum cash balance, and then if you start going up, then those amounts stop being counted as a use because it's just part of normal operations at that point. Um, so partial uses: debt service, non-finance costs, closing costs, construction, developer fee, asset management fee, financing, debt placement fee, and then any negative operating income would also potentially be a use that you would have to fund with something if you had negative burn in the initial months. This is awesome. I actually only started doing this dynamic sources and uses on the last big model. I can't remember which one it was. Might have been the fix and flip model, another real estate model, but it's very useful for any business and any financial model template, really. I love how this works because before it was always a problem where you had, initial period 0 sources and uses, and then you kind of just had to, if you built the model, all the assumptions, and were good with it, then maybe you manually like sum up what amounts are part of the burn that have to be used, and it was just not easy. This is all automated, and all it drives off of is simply the total operating cash flow of the business. And then obviously I'm picking the rows that make sense to put in there dynamically versus what is happening in period 0, and this all auto populates. The summary version is just a higher level, so less detail, but same numbers. And you can see we did change some numbers in the front end, and I'll update that real quick. This still all balances out. And it should, as long as you're just changing the cells in yellow, everything should be just fine. All right, what did I change, if anything? I can't remember. I had to have done something to change the exit value. So let's go back to the monthly, or these last two IRRs. So 17 million. So if I had to change, again, we can manually define distributions in this IRR2 waterfall, but I'm going to go zero it out and then see, okay, there's 81,734 left. So 81,734. And then for the other preferred return option, put 81,734, 897. And then all these inputs are defined right on the actual tab itself. I just brought the summaries of these, the final results, up to the global control, but you're going to define these right on the tab as far as the hurdle rates, contribution rates, the distribution rates, and the cash in and out here. And that's why, mainly because this was going to be on these tabs, so I figured, well, you might as well just have this here too and not try and bring half of it up to the global control and then have the other half here, because you're not saving any movement, because you still got to come here to put in, these cash flows. And again, these are not mandatory. These are optional scenarios. You can delete the tabs if you don't want them. That's fine. The main one I definitely would keep is this one. This is automated and it's showing based on the stream of cash flows of the project, the minimum cash up front, and then available cash distributions afterwards. And then it's just a straight percentage split between the investors and operators. I would not delete that tab. And then the monthly IRR you may or may not be using. This is for more sophisticated waterfalls. But it is there and all coded correctly. And here's the annual summary is just the sum total of the monthly on each year. Okay. Yeah, so I don't know what I changed. I'm trying to think, what did I change to result in that 17 million? See, these are back to our balance. And these two, because I'm just copy pasted values, they're slightly, there's 50 cents there still, which is fine. What did I change? I can't remember. Oh, no, I didn't change the purchase price. Venue assumptions. I can't remember. No, I didn't change any OpEx. That was the same. Well, if you look back in the video, you'll probably see I changed something from how it was when I originally started this video, and whatever that was resulted in about 17 million extra dollars being available at the end of the period, which, number one, automatically picks that up because we have a formula here that at exit it distributes whatever is left in the capital account, so that's why I didn't have to update that. And then the number two is automatically updates. So that was fine. What did I change? I can't remember. Well, I'll go back and look after this is done to see, but I'm sure I had to have been something something somewhat significant. Now, if you want to download this, we'll go over here. It'll be at smarthelping.com in the general industry, in this section here. Now, this is just a small amount of the real estate models I have. If you go to the real estate bundles tab, which you can find it from the home page. So here is where we were just at general industry. If we go to real estate, I've got all kinds of underwriting templates here. I think it was the hotel analysis that had that sources. Yeah. This was the first time I really did that detailed dynamic sources and uses. Anyway, I'll put it right up here in underwriting templates. It'll be called something like venue or event business or something like that. I don't know. It'll be the next one up here though. What do I call this? Venue or wedding hall? Yeah, something like that. I'm going to charge $75 one-time fee if you do want to download this and play with it or use it for your underwriting. You can also, it'll be included in the real estate bundle for $299, which includes all these other templates. It'll also be in the industry specific bundle for $299 that includes all these other industry specific templates. Oh, so the reason why these are real estate models here that are also included in the industry specific bundle, that's why I'm calling them out specifically here. And then I think I also have, let me go to template discounts, pre-configured template bundles. Yeah, hospitality. So I'll include it in here as well. In this bundle for $179, which includes a couple of these other ones. If you just want to skip the chase and get everything, you can go on the sidebar here, look up the Super Smart Bundle, click on it. This includes, every single template I've ever built, and it includes access to everything I build in the future for $4.99 one-time fee. I've had a lot of people buy it. It's been super valuable. I can't tell you how many hours and work and just logic going back and forth with the clients it took to build and know how to build all these templates. There's if you go to the financial models tab, you can see them all here listed. There's hundreds, and all of them are unique, specific to their industry or just a tool to use for different things. So all sorts of things going on here at Smart Helping. You can also hire me. My rate's $275 an hour. I now do have the PayPal option where you can pay in installment payments over time if you choose PayPal, or you can just check out with a credit card. That's fine. And I usually get back to people within 1 to 2 days. Not back. I usually finish at least the initial job scope within a few days. It's quite, I can get quite a bit done in 2 to 5 hours on a model. So let me know. You can email me for inquiries on that. Other than that, I don't think I have anything else. What in the world did I change on here that resulted in that $17 million difference? I do not know. Oh, here, it was the refi. Okay, so you can see the refi, we refied both of these. And I believe what was the interest rate was low. No, the interest rate was the same. So if I put no back on these, because these were at no. Yep, there's the 17 million amount. So now at no, there is what? This is kind of nice to have so you can see what, if you change something, how it actually affects. So if you don't refi, you've actually got 17 million more dollars. If you don't refi, if you refi, you're getting more cash up front here, like in the early years, because you're refi taking that money out. But you're because of the large amount of the refi, you're going to pay more interest. So if you look at the whole thing over the 10 years, you're actually getting more money by not refining. But some people, it depends. Like it's good to have a refi option in a model to see what that looks like and see how it can enhance returns, because most people go on IRRs, and that means if you can return more money quicker, the IRR is going to be higher, even though you're paying more interest over the long run. I'll put these back to yes, since that's what I last left these for. Okay. All right. So hopefully, my goal is to show you guys how the model works, play with the numbers, so then you can go in here right away and start changing things and see how it works. So hopefully that's what I've done here. Anyway, I loved how this turned out. There was so much. I spent probably 5 straight days working on this thing. I'm really happy with how it turned out, and I'll see you guys on the next one. Like and subscribe.